This is the third video on chapter 13. I hope it's the final one, but let's see how it goes. So this is an important new concept which you probably haven't seen yet, where we would have a budget constraint over time. So let's put present consumption on the horizontal axis and future consumption on the vertical axis. In each period, the person gets income. So let's say the nominal income in the first period is Y0 and the nominal income in the second period is Y1. If the person consumes her income in each period, then she will have a consumption point E0 at the blue dot. It's possible just to consume all your income and save nothing. So we have consumption on the axis, but we can also have income in the graph if the person consumes income, and we can have savings in the graph. For example, let's say the person wants to consume at point D. I'll get to that future consumption bit just now. Let's say the person wants to consume at point D. What will she have to do? Well, she will have to save some of Y0, put it in the bank and earn interest on it, and then be able to consume more than Y1, and that's where the future consumption is equal to Y1. That's next year's income plus the savings from this year is 0 times 1 plus the interest rate. So we assume that income from the present can be converted into income into the future at rate R, which is the interest rate. So can you see future consumption is possible to be more than Y1. Point D is above Y1. That means the person wants to consume more in future than her income. How can she do that? Well, she can take savings from this period, S0. So Y, can you see she consumes at D in the first period, which is less than Y0, so she's saving some. Let's say she's saving A0, invest that and get a return of 1 plus R. So what is the maximum that the person can consume in the second period? The maximum is B. The maximum is B if she saves all of her income into the future, and she could also consume all of her future income now at point A if she borrows all of her future income and to consume it now. So the slope of the budget constraint is 1 plus R, it's a negative slope, so it's minus 1 plus R, which is the rate at which income in this period can be converted into income in the future, or if you borrow money from future income and want to consume it now, as many consumers are actually doing, then we assume that the rate is also R at which you can borrow. Now in practice, the savings rate and the borrowing rate is two different rates, so one would actually not have a straight line BA, but you'd have a kink at point E0. But just to make it simple, this is how this works. So how does the person, for example, get to point F? Point F means she wants to consume more more than her current income, so she has to borrow money. So she wants to consume more, and that means she has to borrow. She will have less than Y1 to consume in future because she's using it now. So this brings us, and this is basically the same graph, figure 13.3. I just wanted to explain the budget constraint first. So we still have point E0, and we have A and B and so on, and D and F. I had all that points in the previous slide. But the point now is what will happen if savings is taxed. So we saw that the income is in the two periods is Y0, Y1. Then the person saves Y0 minus C0 is S0 and invests it into the future so that she can consume C1 in the second period and C0 in the first period. So you can, this is very common. So during your working life, you save money so that you have money, so that you have enough money to live from when you are on your pension. So how would a tax affect this picture? So let's say we tax savings. That means taking money into the future will result in a smaller amount of money taken because the government takes some of it. Now the slope of the blue line is flatter because for every rand that is saved, R is earned in interest, and now that R is taxed, and you only keep 1 minus the tax rate. So that's why the slope of the blue line is not 1 plus R, but 1 plus R times 1 minus T. The interest, you only remain what after tax has been subtracted. So a flatter line will then give an indifference curve such as U1 at E0. This is a possibility. So can you see what could happen? Currently the horizontal arrow to the left shows the size of savings. But look how it changes. It becomes smaller. It used to be the long arrow between Y0 and C0 is savings, and that's taken into the future by the vertical arrow. But now savings has decreased because it's taxed, and much less money is taken into the future because the government takes a portion of the interest on savings. So this shows that if the government taxes savings, person's behavior will change. They may decide to save less than before, and you can see there's an excess burden because we have moved down to a lower indifference curve. So does this have to do with equity or efficiency? Excess burden also always have to do with efficiency, so the tax on savings is not as efficient as when the general tax on everything is implemented. Okay, so what's left is the economic effect of the personal income tax. In 13.4.2 they talk about equity. You don't have to worry about box 13.3, so only that paragraph above the box is applicable. Now you should immediately remember what equity is all about. Remember the three terms: ability to pay, the benefit principle, and tax incidence. So what you will notice in this paragraph on personal income tax, they don't mention the benefit principle. They only mention ability to pay. So from a fairness point of view, a personal income tax is fair because it lends itself to the application of the ability to pay principle. There are various ways in which the government can use the ability to pay principle with the personal income tax to make the tax very fair. The second thing that you should notice is incidence. So who ultimately bears the burden? That's tax incidence. And I have an example here where there could be a difference between a tax on men and a tax on women because they would react in different ways. It could very easily be that a very high income tax rate could make someone decide, no, I'd rather be at home and raise my kids than paying so much tax to the government. So if that happens, then it could be that the incidence on is not the same, and that tax could be shifted back onto the employer if the person decides not to continue working or to work less than before. So the administrative efficiency of personal income tax it's not so easy to make it efficient, because the personal income tax is complex. Now you can just think of all your friends studying CA to become CAs, or just accountants and so on. They have to work through books and books and books full of tax law and tax rules, tax calculations. It's really a very, very difficult thing, and it just becomes more difficult every year as people who try to avoid the taxes become more clever. So the PIT is definitely not very difficult to administer. So what they do is they mention one way of simplifying, namely to reduce tax rates and to make the tax laws as simple as possible. Have you heard of the Laffer curve? So the Laffer curve looks like this. They have the tax rate on the horizontal and the tax revenue on the vertical. You can think of, let's say, point 0. If the tax rate is 0, how much revenue will the government earn? 0. If they don't have a tax, then they don't get any revenue. Or if the tax rate is really high, let's say 100% or close to 100%, then people will just not work because the government takes everything. So can you see that the two blue dots must be on the Laffer curve? And so between the curves, the revenue would go up to reach a maximum at R3 and come down again to P0. So the point is that it's not always, revenue will not always increase when you increase the tax rate. If the government is at point C, for example, if the tax rate is really high at point C, then if they reduce the tax rate to B, then the revenue will increase to R3. So the government should be aware of the rates. The lower the rate is, the more compliant persons will also be, and sometimes they would be able to increase the tax revenue. Then flexibility. In this case, you should read about the personal income tax as an automatic stabilizer. What you must absolutely know is the difference between bracket creep and fiscal drag. Many economists confuse the two terms. It's not the same thing. They are related. The bracket creep means that the government doesn't change tax brackets when there's inflation, and your nominal income automatically may move you into a new tax bracket. So they regularly in South Africa try to keep the real income relevant to the tax brackets. And then fiscal drag is the result of bracket creep. If the government, if everybody pays more and more and more taxes, that means, I don't know if you've learned this in macro in the second year, but taxes are leakages from the economy, and the more taxes paid, the slower the economy will become if that money isn't put back into the economy. So you should also be able to show with that the tax tables that we made the calculations with, how the situation would change in the case of bracket creep. If someone's income increases by 10 or 20%, you should be able to make the comparison with calculations and report on that as well. So that is then the end of chapter 13 and the end of the third video.